Hey there, financial explorers. Ever wondered about the invisible thread connecting the Great Depression, the 2008 financial crisis, and the everyday financial escapades of ordinary people? The Great Depression and the 2008 financial crisis might seem like distant chapters, but their echoes resonate throughout time, offering valuable lessons for steering our financial ship through present-day storms. As we dissect the events that shaped economies, crashed markets, and affected people's everyday lives, we'll discover invaluable insights that can illuminate our path to a more secure financial future. In this episode, we'll dive deep into the fascinating world of financial leverage, exploring how it played a pivotal role in these historical events and continues to influence our financial landscapes today. Welcome to another episode of Fun with Finance. The Roaring 1920s, the era of jazz, flapper dresses, and the birth of modern technology. Picture this, a time when the world was ablaze with technological innovations, economic prosperity was the headliner, and optimism was the main act. But wait, there's more. It was also the age of what President Herbert Hoover colorfully dubbed an orgy of mad speculation in the U.S. stock market. It was a decade that wasn't just about the Charleston dance, it was a dance with economic highs and catastrophic dips in the stock market disco. To fund their stock purchases, many individuals and financial institutions used a practice called buying on margin. In other words, they used their existing capital and borrowed money to increase the size of their investment. This leverage allowed them to control larger amounts of stock with a smaller initial investment. However, it also made them highly vulnerable to stock market fluctuations. By 1929, many stocks traded at exuberant prices, and the Dow Jones Industrial Average had increased by around 500% since 1924. However, beneath this apparent prosperity lurked signs of an impending crash. The market's meteoric rise was driven more by speculation and inflated values than genuine economic fundamentals. The widening gap between stock prices and corporate earnings and the unsustainable levels of margin trading created a fragile and precarious market environment. Gripped by the prevailing optimism, investors seemed oblivious to the inherent risks, and the stage was set for a crash that would reverberate through financial history. On October 24, 1929, panic selling and plummeting stock prices began, causing an 11% decline in the Dow Jones Industrial Average. Another severe sell-off occurred on October 28th, eroding 13%, and finally, another 12% decline on October 29th, which came to be known as the Black Tuesday. The panic selling was fueled by those who had borrowed to buy stocks and faced margin calls, or demands to repay borrowed funds, forcing them to sell even more stocks at steep losses. The market continued to decline, ultimately reaching a low point in 1932 when it fell by approximately 90% from its 1929 peak. When people rushed to withdraw their money from banks to cover their losses, the banking system, which was leveraged and unstable due to its involvement in the stock market, could not meet these withdrawal demands. This led to a wave of bank runs and bank failures. The severe banking crisis led to a contraction in credit. Banks curtailed lending, and the businesses could not access the funds to operate. This credit crunch further exacerbated the economic downturn, leading to widespread business failures and unemployment. The economic turmoil resulting from the stock market crash and the banking crisis created a deflationary spiral. Prices fell, which made it even more challenging for individuals and businesses to repay their loans. By early 1932, well over 10 million Americans were out of work, 20% of the labor force. And in big cities, the numbers were even worse. Thousands took to the roads searching for work, and many more stood in breadlines. For generations of Americans, it was one of the defining experiences of their lives. Fast forward to the early 2000s, when people believed that buying real estate was as stable as a cat meme on the internet. It was a time when folks thought their property values would only go up and up. Little did we know, those rock-solid investments were more like Jenga towers waiting for someone to pull out the wrong block. In the lead-up to the 2008 crisis, investment banks were prominent players in the mortgage market. They created, sold, and traded complex financial products such as mortgage-backed securities, or MBS, which were essentially bundles of mortgages. Investment banks heavily employed leverage to bolster their positions in MBS and related securities. They borrowed substantial amounts of money, often at low short-term interest rates, to invest in these securities. The leverage used by some institutions was staggering. For example, in 2007, Lehman Brothers had a leverage ratio of about 30-1 before its collapse, meaning it had borrowed $30 for every $1 of its own capital. Leverage offered investment banks the opportunity to amplify their potential profits. In a rising market, this approach could be incredibly lucrative since, with even a modest increase in asset values, the returns on their investments would far exceed the interest costs of the borrowed funds. However, as the financial crisis unfolded, it became clear that leverage had a dark side. When the value of the MBS and related assets began to deteriorate due to rising mortgage delinquencies and foreclosures, the losses were exponentially magnified due to the leverage employed. Banks faced a double-edged sword. The same leverage that had boosted their profits now threatened to wipe out their capital. Just like the dance of doom orchestrated in the Great Depression and the 2008 financial crisis, individuals today are unwittingly participating in their own leverage tango. It's just like the Lehman Brothers' risky financial ballet, but on a smaller stage, your wallet. Juggling credit card debts, hefty mortgages, and car loans, some folks are unintentionally starring in a tragicomedy of their own making. Just as Lehman faced a liquidity crunch, too much leverage can turn life's script into a melodrama. Leverage can manifest in various forms in people's lives, both as a financial tool and a potential source of financial trouble. Let's explain how this might happen with a few examples. Number 1. Credit card debt. Credit cards exemplify leverage as individuals borrow money, credit, to make purchases, amplifying their spending power. When individuals rely on credit cards for everyday expenses and don't pay off the full balance each month, they accumulate high-interest debt. This can lead to a precarious debt cycle as interest charges pile up. Minimum payments become challenging and credit scores suffer, making it more difficult to secure favorable loans or financial opportunities. Number 2. Mortgage default. Mortgages epitomize leverage, allowing individuals to buy homes using borrowed funds. Homebuyers may take out mortgages near the upper limit of their affordability, leaving little room for unexpected financial setbacks. Job loss, medical expenses, or other unanticipated costs can make it challenging to meet mortgage payments. Defaulting on a mortgage can result in foreclosure, causing the loss of the home. Additionally, credit scores also take a significant hit upon foreclosure, affecting future borrowing and financial prospects. Number 3. Margin trading in the stock and crypto markets. Investors use borrowed funds to amplify their investments, expecting higher returns. If the market experiences a downturn, losses are magnified. Investors may face margin calls requiring immediate repayment of borrowed funds, potentially leading to a financial devastation. If an individual uses a leverage ratio of 30-1 as Lehman Brothers did in 2000, even a 3-4% decline in their investment would result in a loss equivalent to their entire equity capital. Even a more conservative leverage of 5-1 can end in catastrophe. Number 4. Personal and payday loans. Personal loans are a form of leverage enabling individuals to make purchases with borrowed money. Some people take out personal loans for non-essential purchases like vacations or luxury items. Accumulated personal loans can result in high interest payments that strain finances. Payday and high-interest loans involve borrowing to meet immediate needs, often at exceptionally high interest rates. The high interest rates and fees can trap borrowers in a cycle of debt, making it challenging to break free. In each scenario, leverage, whether through credit or loans, can transform a potential financial solution into a significant financial problem. Finding the delicate balance between harnessing financial leverage and avoiding excessive risk is like navigating a tightrope between financial aspirations and potential pitfalls. While we can't predict every twist and turn in the financial circus, we can approach it with some preparedness. If you're considering using financial leverage, approach it with caution. Minimize debt for depreciating assets like cars, prioritize paying off high-interest credit card debt, keep housing costs, including mortgage, affordable, contribute consistently to retirement accounts like 401k or IRAs, ensure adequate insurance coverage for health, life, and property, and adopt a frugal mindset and live below your means. Leverage can amplify both gains and losses, so it's crucial to use it judiciously. As Warren Buffett said, don't risk what you have and need for what you don't have and don't need to avoid unnecessary risk, especially when the stakes are high. The echoes of history serve as a cautionary tale, whether on the grand scale of economic crisis or in the personal finance decisions of everyday people. The consequences of excessive leverage can be profound and far-reaching. So here's a gentle reminder. In the grand performance of personal finance, be mindful not to let leverage steal the spotlight and turn your financial story into a Shakespearean tragedy. In the meantime, please hit that like button and subscribe for more financial adventures. Until next time, stay financially fabulous.